In this learning, we are talking about how call option selling works. So this is about when you sell a call option and then you have to do the numbers that whether the situation is in your favor or the situation is against you when the time comes. So here is the mathematics or numbers for you. Suppose you are seller of a call option and you have written 5 call options of Barrick Gold Corporation and the strike price is $35. It means you have agreed that if on expiration, if you are assigned, you will be selling the shares to the holder of the call option at $35 each. And for writing this call option, you have received from the call holder or the call buyer option premium of $2 per share. And right now the price is $34 in the market. So let us do this mathematics that whether the situation turns in your favor or against you when the expiration in future comes, which is in coming February. So first of all, we have to reiterate this fact from previous learning that when you are a call option writer, you are in a position which is called a short position. And you have a bearish outlook for this stock. So you will write a call option and you will receive option premium and then you will think, okay, the price of the share is likely to go down in future. You have bearish outlook and that is why you have written the call options maybe at strike price of $35 and you think the price of this stock will go down and you will get to keep this option premium that you have received from this call option buyer. So if at all you are assigned on expiration, then since you have written 5 contracts, you will have to sell 500 shares at the rate of $35 each. So every option contract has 100 shares. So since you have written 5 call options, so it means in this contract 500 shares are agreed upon. And in order to do the numbers, let us assume some scenarios at expiration, which happens at time t in future. When you are call option writer, you had bearish outlook and strike price or exercise price was 35 and you have the bearish outlook. And bearish outlook means that you thought, okay, in future at the expiration the price of this share will go down. So it may be $30, $32, $34, anything less than the strike price or exercise price of 35 or even 35, you won't lose anything. This is some situation where you will be kind of in a beneficial position. So the situation when price goes down at the expiration is a situation which is in your favor, right? So in that situation, there will be some call option writer's profit that you will be making, and let us see how it works. So this call option writer's profit is denoted by this Greek symbol pi, and its value is equal to minus max of these two numbers, which is 0 and price on expiration minus strike price. So these two numbers are written in bracket 0 comma market price minus strike price, and we take minus of maximum of these two numbers, and we add to that the option premium that this call option writer has received or you have received as a call option writer, and this will give you the profit that you will make as a call option writer or call option seller. So if the price goes down to 30, in this situation, naturally the buyer will not exercise his or her right to purchase share from you. So you won't be assigned, because in market this is selling at 30 and you have agreed to sell it at 35, then why that buyer would purchase it from you? So as a call option writer, you won't be assigned. So if the market price on expiration is $30, so as a call option writer, you won't be assigned, which means you won't have to sell the shares to call option buyer. In this case, your profit would be $2 per share because you will get to keep that option premium that you initially received from call option buyer. So that is your profit. So if the total profit in that case would be $2 is per share profit, and then 5 times 100 is 500 shares that you have to that were mentioned in the trade. So you get $1,000 worth of total profit from this transaction, and your per unit profit is $2 per share. But if we take the opposite situation, when you were bearish and the exercise price was 35, but the price kept on going up, and on expiration actually the price of share is $40. So this situation actually has worked against you. So in this case, your profit would be again through the same formula that we studied earlier, the same formula, and when you put these numbers, your option profit comes out to be $3 per share, but this is a negative number, and it means that you will have a loss of $3 per share. How come? Because in the market price it is $40 per share. So you will have to purchase a share at $40, and then you have to sell to this guy at $35. So you have a loss of $5. Your outflow was 40, your inflow was 35, so you had a loss of $5. But initially you had inflow of $2 per share, which was the option premium that you have received from the call option buyer. So your eventual final profit from this transaction would be $3 per share. So you can compute it this way, the way I showed it, or you can compute it through the formula, but the answer would come out to be same, that if you are assigned, if the price of share goes up and you are assigned to sell shares, then you will incur a loss of $3 per share. And since there were 500 shares, because there were 5 contracts of 100 shares each, so your total loss would be minus $1,500. So when the market price of share on expiration is exactly 35, so which is that this market price on expiration is same as exercise price, even in that case you won't be assigned, right? There is no fun for the buyer to purchase at 35 from you, and because it is already available in the market at 35, right? So you won't be assigned, and in that case you will get to keep the option premium that you received from this call option buyer initially. So this is how the math works when you are a call option writer.